Yields higher, equity softer. From New York City this morning, good morning, good morning. Your price action shaping up as follows. Negative 0.1% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Live from New York, we begin with the big issue, a synchronized global bond market sell-off.
If you look at just the bond market,
we are making an adjustment higher in yields.
The Fed has pivoted.
We're at a turning point, a new regime underway.
The environment is one of tightening policy.
As it relates to the bond market,
when you start to see these types of moves,
it's this fear that the Fed is going to overdo it.
There are some limitations as to how high these yields can go.
As the Fed and global central banks pull back,
that's going to cause some challenges.
The Fed is further and further behind, and they're going to have to catch up.
These rises in yields are now starting to have a negative feedback impact on credit spreads.
Spreads are widening out
because of the adjustment going on in the bond market.
Yeah, that's going to be a bit of an overhang for the next couple of maybe weeks or so.
Joining us now, pleased to say, Pictet's Hoxha, Neuberger Berman's Erik Knutzen, and JPMorgan's Jack Manley. Ella, let me begin with you. You think this flattening trend in this bond market will continue. Why?
Broadly speaking, the setup that's driving central banks to pull policy tighter from the monetary side is still intact. In the sense we're still facing high inflation prints as we speak, although that is a lagged indicator. And at the same time, we're looking at a growth backdrop that's still benign and above trend. So with that in mind and the types of valuations that we saw rise over the course of last year, pretty much across all asset classes, the setup for central banks is to continue to tighten monetary policy.
And Erik, it's not just the Federal Reserve, it's not just the Bank of England, seemingly it's the ECB now as well. So we've got some synchronization here, Erik, in a way that we didn't in the previous tightening cycle of the Fed. Let's talk about the destination. How far do you think they can take this?
Well, we're definitely entering into a global tightening cycle. In fact, it started last year with emerging market central banks, most of them raising rates late last year, Bank of England, Norges Bank, and you know, what we're looking at right now is more what's priced into markets. There's no doubt that central banks are moving to rate hikes. The Fed will hike rates this year. We think it'll be more like 4 than 5 this year, as there will be, you know, kind of pressure on the growth side. And what we're looking at is whether markets are going to be trading rising rates and inflation, or we think there's going to be alternating days where they start to focus on the growth side and the concerns that growth is not as robust as expected, in part because of the impact of rising rates. So we think there will be more two-way markets around interest rates. Having seen this big move, rates up to 194 and 195, you know, we think that the 10-year or our 10-year targets around between say 2.1. We've gone a lot of the way there. So we actually would be looking to take down some of our duration underweight here, buy back some interest rate exposure as markets get more two-way in the short term.
Well, certainly we've done a lot of work very, very quickly year to date. Looking at that 24 dot in the Fed dot plot, Jack Manley, 2.1% is the median dot in 2024. Bill Dudley, formerly of the New York Fed, called that fancy land. He thinks they've got to go much, much higher. As you think about the destination and how far we can push this, I'm just looking at the belly of the curve start to lift up a bit again. Are you questioning too, Jack, the destination, the end point of this Fed hiking cycle?
I think absolutely, John. I mean, when we look at what's going on with the Fed at the moment, very clearly it feels like it's been backed against the wall, given the strength of the labor market, given the strength of the economic recovery, given the persistence of hot inflation. We'll be getting another print very, very strong this Friday. But I do struggle, John, with this narrative that the Fed has to pull a lot of levers right now. You know, I can see a Fed that can very easily get inflation in check at the moment. The only problem is that it has to sacrifice the consumer to do that. It has to make life so unpleasant for us that we're dealing with higher prices and higher borrowing costs, and all of a sudden supply chain issues don't matter anymore because the demand just kind of evaporates. The consumer is the engine of growth for this economy. That translates directly into a recession. That's what Paul Volcker did in the late 1970s in the Carter administration. I don't think the Fed wants a recession. And so, I see this narrative of rising rates making a whole lot of sense this year, but the aggressiveness that a lot of market participants seem to believe in, I don't really see that materializing. That 4 rate hike commentary, I'm much more in line with that, maybe even 3 hikes. Forget about 5, 6, or 7.
We're dealing with high yields right now, that's for sure. 10s at 195, up 3 or 4 basis points on a day, approaching 2%. Kelly Lyons, it's been a while since we were that high.
It's all the way back in 2019, John. So yeah, it's been a while, and strategists are saying that nice round number could be very, very close. We are indeed inching closer to it. 195 is where we sit now, and that is a really key level to watch, John, because it is that level or around it where we could see convexity hedging start to kick in, where those holders of mortgage funds need to start hedging against the potential ripple effects of higher yields, and therefore need to sell treasuries in order to protect their portfolio. So that could be a potential catalyst for even further higher yields. You also could see a catalyst from the auction slate this week. At the risk of sounding like Lisa Abramowitz, we do have a lot of supply coming online. A 3-year auction today, $37 billion of 10s tomorrow, and $23 billion of 30s on Thursday. And speaking of the different maturities across the curve, of course, you've seen the movement in the long end, but where it's really been more dramatic is in the belly and the short end, at more than 50 basis points on 2s and 5s so far year to date. With that repricing of expectations, more aggressive hikes expected, as you were just discussing. And that's not just true here in the U.S. That is a global phenomenon. We're seeing it in a big way in Europe at the short end, and specifically in the periphery with spreads blowing out. Just look at BTPs and what's going on in Greece. And altogether, when you put it together, global bonds, worldwide government bonds, are coming off their worst 6 months in 5 years, John, and those declines continue today.
Kelly Lyons, thank you. Jim Karen and Morgan Stanley a little bit earlier this morning talking about the negative feedback loop that we're starting to see into credit and maybe back in to the economy. Goldman's Christian Muller-Glissman is looking at credit for signs that maybe things are getting a little bit tense. Take a listen.
Credit is essentially following the academic world, is essentially short equity put. So the equity volatility should be very closely linked to credit spreads. Maybe the credit market is telling us there should be more concern in equity markets.
Ella, can I come to you on that? Just what's happening with credit versus equity right now and your read on things?
Well, we started to see the proper signs of a feedback loop into credit last week. And it was very much led by the ECB, predominantly because they have tended to mop up a large quantity of the supply on the European credit space. And also because we have a much larger supply backdrop in terms of credit, particularly in this side of the world. And so that repricing clearly initiated by the shift from the ECB, and it seems to be broad-based. Certainly some sectors underperforming, your typical sectors that tend to do worse when yields go up. So your utilities, for example, came to mind, and your tech sectors as well. And so we're seeing the tentative signs, and there's been a bit of pain inflicted. Now, we're still sort of not trading halfway through to where we traded back in 2018 with regards to the option adjusted spreads. So there can be more pain to go, if this persists. And so for the time being, the market probably is trying to find its feet, given it's seen quite a bit of repricing over the course of what is a short period year to date.
Are you surprised by the stability you're seeing in equities, given what you're seeing take place in credit?
Well, actually, this started with equity weakness, as we know. It topped out in November, began in December, and really took hold in January. So actually, we would say probably credit markets have been following equities here. So surprised? Probably the answer is not. We're seeing unprecedented monetary policy tightening at a very concerted pace. So it's not just happening in the US, it's happening in Europe now and elsewhere. And so that, generally speaking, tends to create repricing room for risky assets.
On the tightening, there's two ways of looking at this. Bank of America on the one side, JPMorgan on the other. This from Savita Subramaniam at Bank of America. She says the following: we're tightening into an overvalued market. The S&P 500 is more expensive ahead of the first rate hike than any other cycle besides 99. That ended poorly, and that you know. JPMorgan on the other side of this saying the following: the Fed is unlikely to keep moving further and further into hawkish territory, at least relative to what is priced in currently. Erik, who are you closer to at the moment, Bank of America or JPMorgan?
I think where Jack was, as he said earlier, we've got JPMorgan in the house. The Fed is going to be very, thoughtful about their rate hikes here. They're less likely to, really slow the economy too much. They're going to be very data driven, and that as I mentioned earlier, the markets are going to begin focusing on the growth side as opposed to the rates and inflation side. And I think that's going to create a lot of short-term volatility, short-term sloppiness in markets. You're seeing it now in credit markets. You saw it first in equity markets, and the Fed's going to be paying close attention to that. I think the key question is around recession. We think odds of recession remain very low over a 12 to 18 month time horizon, and that informs the opportunities to take advantage of some of the sloppiness and add to positions, whether it's in credit markets, equity markets, as opposed to expecting, significant drops from here in markets.
Jack Manley, if your conclusion is that the Fed ultimately underdelivers relative to where the market is priced, where does that leave your equity exposure concentrated right now?
So, I still think because we are seeing this rising rate environment, we should expect continued volatility this year. We should expect those more expensive parts of the market to continue to blow off steam. That's not going to surprise me. What we want to look for this year is earnings, and we want quality of earnings. We want consistency of earnings. Now, that may mean value. It may mean cyclicality, but it doesn't just mean those things. Technology is under a lot of pressure right now. It's getting kind of beat up by a lot of people talking about the sort of end of this longer term growth trade. You have to look, even in technology, there are high quality companies that are able to deliver those earnings. So, when I think about equity markets this year, John, it is more a sector and security selection story. It's more an active management story than really anything else. It's not a beta play anymore. There's a lot to be concerned about right now, I think, as an equity investor, but there are plenty of ways to get around those problems through prudent security and sector selection. So still very positive this year when it comes to what earnings can do, when it comes to what prices can do. We just have to be a little bit more careful about where we are looking.
We'll build on that into the opening bout. Jack Manley, Erik Knutzen and Ella Hoxha. Let's get you some movers pre-market going into the open for more. Here's Abby.
John, lots of outsized market movers here in the pre-market, starting out with the shares of Harley-Davidson. The stock is popping after the company beat revenue estimates by 21%, also posted a surprise fourth quarter profit on higher prices, consumers digesting those higher prices. Also, importantly, they see supply chains and logistics improving in the back half of the year. Now, Coty up 3.7%, strong quarter there. Stock is higher. Novavax up down 8.7%. There are reports of COVID vaccine deliveries missing the mark. They're really under-delivering on their promises around the COVID vaccine. And then Pfizer down 4.5%. They missed the fourth quarter revenue estimates on COVID product sales. The outlook is lackluster, showing signs that perhaps the COVID boom for them may be coming to an end, John.
Abby, thank you. Coming up next on this program, the US and Germany presenting a united front.
Germany and the United States, together with our allies and partners, are working closely together to pursue diplomatic resolutions of this situation. And diplomacy is the very best way forward for all sides. We both agree.
That's next. This is Bloomberg.
If Russia makes a choice to further invade Ukraine, we are jointly ready and all of NATO is ready.
Diplomacy efforts continue. The US and Germany presenting a united front in D.C. as President Macron travels to Ukraine after speaking with Vladimir Putin in Moscow. Macron telling reporters he received assurances from Putin that Russia wouldn't escalate further around Ukraine. Russia has denied any plan to attack the country. Joining us now from D.C. is Anne-Marie Hordern, and from Brussels, Maria Tadeo. Maria, let's just wrap things up. What we've got through in the last 24 hours and what's still to come through today.
Well, there's a lot of diplomacy going on. Of course, Olaf Scholz was in D.C., but in particular, I would argue that it's Emmanuel Macron that's making real news today. He met Vladimir Putin yesterday for almost 5 hours. The French are saying that for them, they didn't really get anything on paper, but they believe that the situation is not escalating and it's not worsening. So for them, that's good for the time being. And then, of course, he is in Ukraine as we speak. He just did a press conference in which he said, and this is very important to stress, that at no point the French suggested that Ukraine Ukraine should become Finland or anything that looks like Finland in this situation. And the way he looks at this, there's two problems that are happening. One is in eastern Ukraine, and the only way to deal with this is through the famous Normandy Forum. Remember, this is Germany, Russia, Ukraine, and France in talks. And then there's a bigger question around NATO. He did say we can talk about NATO, but before we get into that, we need to make the situation stable, and then we can talk about innovative solutions. But before that, Russia has to really prove that they're willing to de-escalate the situation.
AMH, yesterday was a massive opportunity for Chancellor Scholz to tell us what he stands for. Were the German government happy with that visit?
I think they were. Listen, he came out and he was a little bit more emphatic than he has been of all things on the table. And then when the reporters were really questioning him, why will you not say the words Nord Stream 2? Why are you not saying definitively, as the President of the United States just said, Nord Stream 2 will be completely off the table and it will not go ahead if there is a further invasion of Ukraine? He switched to English. I think he was trying to show that he is in sync with the United States and with the allies when it comes to the harsh sanctions package they are preparing for Russia. And then, Jonathan, he went on CNN, he said Germany is ready to take steps that will have costs for us. This goes back to his line about how they want to make sure they are prudent because no one should be under the guise that any sort of sanctions on Russia are not going to have a blowback on them. Just quickly for a little bit of context, Olaf Scholz is in a difficult position. He's part of the SPD party, and their own party is engaging diplomatically within themselves. Domestically, they are at a crisis of how much they want to talk tough on the Kremlin because this is a party that wants to engage in Russia. Also, this is something he inherited. Former Chancellor Angela Merkel, she championed Nord Stream 2, and she came under pressure in 2020 after the poisoning of Alexei Navalny, the opposition leader, that they should scrap this project. And she went ahead with it.
AMH in DC, alongside Maria Tadeo over in Brussels. Guys, thank you. Thank you very much. Crude this morning, 90.21 on WTI, negative 1.2%. On Brent at 91.44, negative 1.3%. We caught up with the CEO of BP a little bit earlier this morning. This is what he said.
A lot of uncertainty, but what I will say is that demand is strong, and you can easily see a further tightening market throughout this year. But more than anything, I think we should expect some volatility. And at the end of the day, we don't know what the price of oil is going to be.
And nobody really does. Jack Manley, this has been a hot part of this equity market. Energy in a commodity market, crude flying year to date. Do you want to chase this?
I think you could probably chase it for a little bit, John, but to me, it's too tactical and it's too uncertain. You know, I would agree that there is clearly a good amount of demand for energy products at the moment. But to my mind, so much of what's going on with energy prices right now is much more supply driven. And you can really go all the way back to the start of 2021 and point to different instances throughout the course of that year that contributed to oil being at the price that it is right now. I don't think WTI should be trading at $90 a barrel. I think especially with the United States as the marginal producer in global energy markets, we could see oil fall off $20, $25 before it settles into an area that is a little bit more sustainable. Now, short term, there's a lot of risk to that supply side story. And so, of course, we could see oil prices move higher, especially if there are sanctions against Russia in the event of an invasion of Ukraine. But as things stand right now, John, the fundamentals to me don't really support this story for long-term energy outperformance. But to tell you the truth, I was saying that last year and it didn't really work out in my favor. So there's so much uncertainty. I just think we need to be aware of that.
Well, at least you're honest. $25 would take us back to about November, December time, by the way, because the rally has been this quick and this strong. Erik, your thoughts on the energy sector in the equity market, where we've seen some fantastic performance in the year so far?
Sure. This time I'll take the other side of Jack. We'll take oil between 90 and 100. We think that you know, the supply-demand imbalances will continue to put pressure on oil price, all within a much more volatile environment. So I think that's very important. We're going to see major fluctuations day by day. But at that level, the global economy has worked just fine for periods in the past, and we think that we're likely embarking on a longer-term commodity cycle where supply-demand imbalances, the need to move towards the decarbonized global economy, and everything around that, along with what we think is likely a weaker dollar going forward, should put pressure continue to apply upward pressure on commodity prices. And in a cross-asset environment, we think that it can be helpful both in terms of the positive return opportunity, but also helping to hedge against what we think is likely some structurally higher inflation going forward.
Ella, you get the final word on this one. Final word.
From a bond PM. We would say, I would say we're more in line with Jack, sort of medium term, down the line because of the lower exploration and lower oil rigs that we've been seeing. So there could be a pressure on oil prices further down the line for years to come, and the energy transition is likely to be more inflationary than not on the energy side, at least for many years to come. This year, it's a different story for us. We're a little less bullish on the growth backdrop. Of course, we would be, we're global bonds. But broadly speaking, we see the demand setup to be weaker this year around, and predominantly that has been driven by China, particularly on the commodity side of things. So we think there could be some surprises for commodities over the next 6 months. So different story, short term to medium term.
Ella Hoxha sticking with us alongside Erik Knutzen and Jack Manley. Coming up on the programme, the morning calls, and later, strategists divided on Wall Street as the earnings pour in. From New York City, this is Bloomberg. 5 minutes away from the opening bell. Equities just a bit softer, down 1/10 on the S&P, down 1/4% on the Nasdaq right now. In the bond market, yields higher through 195 on 10s, 195.77. Yields up by 4 basis points. You have to go back to the summer of 2019 to see yields this high on 10s, on 2s. 132. That's the price action here at the morning calls. First up, Wells Fargo cutting its first solar price target to 88, expecting higher rates to fuel a rotation out of renewables and growth stocks. Morgan Stanley downgrading GM to equal weight, forecasting a challenging year ahead amid rising execution risk. That stock is negative 3.51% to 48.93. And your third and final call, BTIG downgrading Airbnb to neutral. The analysts citing concerns about slowing growth and overly optimistic earnings expectations. We're down 3% in early trading to 153.10. From New York, coming up next, division on Wall Street. There always is. Morgan Stanley expecting weaker earnings as UBS bets on robust growth. Equity futures a little softer on the Nasdaq. Your opening bell is up next. Equities are just about holding on here. From New York City, good morning to you all. This morning, the price action down 1/10 on the S&P, no drama so far. On the Nasdaq, down about 1/3%. On the Russell, down a single point, negative 0.05%. The opening bell in New York City rings, switch up the board and get to the bond market. We look like this on 10s. Yields breaking out again at 4 basis points and pushing 196, 195.59. Not just stateside, on the other side of the Atlantic too. In Europe, look to Italy for a 7th straight day. Yields are higher in Italy, 187, let's call it 188. In 7 days, we're higher by almost 60 basis points. So keep going back to this. Think about the move we've seen year to date in 10-year yields in America. It feels brutal, right? We've done more than that in 7 days in Italy as the ECB tees up doing something maybe in the back half of 22. In the FX market, euro dollar just a little weaker on the euro side of things. We're negative there on that currency pair, 0.2% to 114.17, and crude backing off 1.6% on WTI to 89.85, down about $1.50, down by 1.6%. To be precise. As we open things up on the S&P about 50 seconds in, we open negative 0.01%, positive now, no drama. Bottom of the pile, communication names, we're down 0.4% at the top off the back of this move in treasuries. Yields higher, treasuries up, yields up, financials up by 0.7%. Here's the quote from HSBC that got our attention. It reads as follows. We think the next big thing to cut will be cyclicals in Q2, as it will become increasingly clear that global growth momentum decelerates in earnest. The crucial question then is whether the Fed is more likely to hike 3 or 7 times from the current 5 being priced in. Erik Knutzen, that's your world. That's what you're thinking about. Why is it so important?
Yeah, I mean, that path of the rate environment, and again, whether markets are trading inflation and rate increases or a declining growth environment, is going to be critical for the market setup. We do think that we won't go with HSBC in terms of the timing of that. We think there's more room for cyclicals to go here. We want to be underweight unprofitable tech and to a certain extent big tech at this point. Through another portion of the period here, get through kind of peak hawkishness with the first rate hike in March, and then see when in the second half of the year we start shifting more towards that orientation towards growth slowing versus inflation and rates. I will say that the other aspect here is that volatility is going to persist. We want to be able to take advantage of volatility. So another way to play this exposure is to express some of those views in the options market through selling options and capturing attractive volatility premium at this point in the cycle.
Ella, there is a difference between deceleration and weakness. Growth is set to decelerate. It doesn't necessarily mean it will be weak per se. Ella, your thoughts on that?
Well, the consensus entered this year thinking that growth would decelerate. So we don't think that will be the surprise for markets. So you have to think that this deceleration is probably already reflected in the price. So what would be the surprise would be if indeed we actually trade much lower than that in terms of the prints that we get. That would probably catch central banks off guard because they're also operating on the basis that growth, although coming off from the very high levels of last year, will still remain at elevated levels. So that could change the macro backdrop pretty significantly.
Jack, two pieces to this call. Global growth momentum decelerates in earnest. 1, 2, cut cyclicals. Jack, where are you and the team on cyclicals at the moment?
Yeah, I would generally speaking agree with what Erik had to say, which is that I think there is more room to run than just through the second quarter on cyclicality. And I think a lot of that has to do with the fact that particularly in the US, there is still more momentum from a growth perspective. I tell clients, I don't think we're on the cusp of a paradigm shift where value or cyclicality is going to outperform over the next decade relative to growth. I don't think that is the case. But if you look at the high frequency economic indicators that are out there for things like the travel industry, leisure, hospitality, you see how these things got beaten up because of Omicron. I think there is at least a couple more quarters of strong growth to come before the economy starts to settle back down into a more ho-hum kind of pedestrian pace. And if that is the case, it is those value names, it is that cyclicality that is more levered to that growth story. In particular, John, and I've said this before, so I know we've talked about it, but I do still like the financial story. Now, a lot of that hinges on what the Fed ends up doing. How effective is it in controlling the shape of the yield curve? But I am generally speaking an optimist on that front, and I think that this could be a really nice environment for big banks to make a whole lot of money as long end yields drift higher and that curve maintains some sort of steepness, or I should say steepens as QT begins in earnest.
Let's come back to that call on banks in just a moment. Two earnings stories I want to pick up on. Pfizer number one, down 5% of the open after the outlook misses estimates for 2022. Just about in positive territory. Peloton, after getting absolutely slammed yesterday, that's up by about 1.5%. On the West Coast, let's get to Ed Ludlow for more. Hey, Ed.
Yeah, morning, John. Peloton bouncing all over the shop. And the big news is that John Foley, the CEO and founder who brought this company into being a decade ago, is stepping aside and becoming executive chair. Barry McCarthy, you see there on the right hand of your screen, he's a former CFO at Spotify, former Netflix executive. He comes into the fold as CEO, and the street likes this, John. JPMorgan's Doug Anmuth calling this a known entity move, somebody that's very familiar with subscription-based businesses. And that's the story for Peloton, right? That's what we want to know about the future. How do they manage and transition to a higher margin services and subscription-based revenue? But it also raises a question about the other elephant in the room, John. Does this increase the likelihood of a sale? Because one of the barriers or fetters to a takeover by the likes of Amazon or Nike was this dual class structure, and Foley being a holdout, basically, right? It makes sense. He was the founder. This was his baby, but he'd come under criticism for his management and abilities. You see there, that chart says it all, right? We're well around that IPO price. It's been an 80% drop from the peak of the pandemic. And the story's been that, folks have gone back outside of their living rooms and started using gyms. So the big question for earnings after market today, what is the future? Even if it's not a sale, what is the strategy and how do these C-suite changes make that happen?
Ed Ludlow, thank you. I should say it got slammed last week. Massive pop yesterday off the takeover rumours, up 21% yesterday. almost 21% of the close, up 4% right now on Peloton. Last week on Thursday, that was ugly at one point, down 9%. It's had a tough time more recently. More earnings. Let's get to Abby for a whole lot more than that. Hey, Abby.
Hey, John. Well, it's super interesting because, of course, all focus on the CPI print later this week and the inflation story that we've all been watching. So far, it's not really affecting U.S. companies on an individual level. In fact, we're seeing a lot of consumer companies in particular really absorbing consumers absorbing price hikes, and that margins are staying steady. In fact, this morning, we had Harley-Davidson report a much better quarter than expected. Sales up 21%, a surprise profit. Those price hikes being absorbed. Tyson Foods yesterday, consumers really absorbing those rising prices as well. That said, margins are not hanging in there for all companies. Right now, for the first quarter of this year, margins down almost a full percent from the peak back in the second quarter of last year at 13.9%, currently at 13%. Nonetheless, you can see relatively holding steady over this year from relative to last year outside of this trough right now. And interestingly, if we break it down just a little bit more, we're seeing a real shift versus the prior year in margins. Communications getting hit pretty hard, discretionary as well, staples down just a little bit. But if you can see it, people seem to want it. Materials and industrials, that cyclical call that one of your guests was just talking about, well, right there, you can see that the margin is hanging in for those two sectors. John.
Avi, thank you. 8 minutes in, unchanged on the S&P, on the Nasdaq, just about positive 0.06%. Let's talk about the small caps. Julian Emmanuel of Evercore weighing in on the small caps. He writes the following: small caps have shown signs of sputtering below their prior support, with Russell 2000's recent track record as a leading indicator for broader market weakness. We will be watching the reaction to this level closely. Erik, can I come to you on the small caps in America? A lot of people talking up this as a potential part of the market that will be okay with rising rates, inflation being a problem too. What are your thoughts?
So in general, we want to be overweight small caps. The category, by and large, is pretty sensitive to economic growth and reflationary pressures. That said, what we think is incredibly important at this juncture is to focus on kind of quality versus non-profitable small caps. Over a third of the Russell 2000 index are comprised of companies that are not profitable. That's the category that's the portion of the category that's really gotten hurt this year, and we think will continue to face pressure. You can combine that orientation towards smaller companies that are geared to reflationary growth with quality earnings, quality management teams. We think that's a great opportunity set right now.
Jack Manley, your take.
I think what Erik said makes a whole lot of sense, and I'd add on top of that there is a very compelling valuation argument to be made on the small cap side of things, particularly on the small cap cyclical side of things. You do want to look for that quality. You do want to look for the ability to generate earnings. You do want to look for solid management, but I do like the idea of small caps. I would just say that any client or investor that is thinking of getting into the small cap space needs to recognize that it is inherently a more volatile part of the market. It's not going to do the same thing as large cap, very high quality kind of blue chips name will do in a portfolio. So understanding that there is more risk associated with that space, I do like that play. I do like that call that Erik made, that I think we want to have a little bit more exposure to small caps than we typically would otherwise, just because of that strong growth story, that strong reflation trade.
Jack, you mentioned the banks a bit earlier. Let's finish there with you. Why the banks work in a world where you think the Fed will disappoint on the level of rate hikes that are currently priced?
Yeah, John, it's a little cheeky, but I'll tell you how I think about this. I don't know where you bank. I won't say where I bank, but I can tell you when interest rates are at 0, I get about 1 basis point on my savings account. The Fed could hike interest rates to 2% tomorrow, and I'll still get about 1 basis point on my savings account, right? A lot of these big banks are able to hold a lot of that extra money. They're able to eat up all that upward pressure on rates by passing it on to you on the long end of the curve when it comes to lending for autos, for mortgages, on your credit card debt, as some examples. The net interest margin story there is, I think, a lot more powerful than the overall yield curve that some people may be focused on, because even if the Fed were to normalize short rates and we were to see a flattening yield curve, that doesn't necessarily end up being what the end consumer feels. And so I look at this environment and I see long end yields drifting higher, especially if the rest of the world starts to normalize as well. That is an environment where net interest margins lead to enhanced profitability in those big banks.
Jack, if Jamie's watching, you should tell him now that you bank with Chase, just to clean it up and get ahead of a problem. You should bank with Chase, I imagine. I want to finish on this with you, Ella. The potential for a steeper curve, you push back against that. You believe in a flatter curve from here. Is that a global call for you, Ella? Does that include Europe as well, or is that just the treasury market?
Right. So yes to flatter curves, and that's predominantly because the market still needs to find what the end point is with regards to terminal rates. Does it join the Fed, which we've been doing, so we're moving in that direction, or as we were saying earlier in the session, potentially even higher. So very difficult to say here. We'll need to assess the growth and inflation backdrop, but we are certainly on the camp that thinks quite a lot is priced in the curves here. 7 hikes from the Fed is pretty excessive. So in order to not disrupt the growth backdrop, you need to kind of pull back from the amount of hikes that you have in, at least over the course of this year. So that's on the US. On Europe, we had been more on the sort of steepening curves debate, but clearly the shift from the ECB is actually pointing in the other direction. And you saw 10-30 swaps in Europe actually start to invert following the ECB meeting, which is telling you that the market thinks the policy setup there is also getting pretty tight or excessively tight. So we're certainly seeing more value in flatteners there, with the belly of the curve, so the 5-year part of the curve, still exposed, in our opinion, to continued repricing.
Ella, thank you. Awesome to have you on the programme. Ella Hoxha there with Erik Knutzen and Jack Manley. Coming up, what a contrast. Australia opening to tourists, Sweden scrapping its COVID curbs, mask mandates slowly going out here in the United States, and Hong Kong going the other way.
It's biologically implausible to eradicate or eliminate efficiently spreading respiratory virus that has an animal host. So COVID-0 was wrong from the beginning.
COVID-0 on China, on Hong Kong. That's next. This is Bloomberg.
I don't think that you're going to see many of these mask mandates at the state level stand for much longer. And indeed, many states, including my own in Pennsylvania, have not had a mask mandate for months and months.
What a contrast. Let's just sit on this for a moment. Sweden getting rid of its COVID curbs, basically all of them. Australia reopening to double vaccinated tourists. And here in the US, state after state making a move. Connecticut, New Jersey, Delaware, all dropping school masking mandates. Over in Hong Kong, we're going the other way. The chief executive, Carrie Lam, saying this: now, given this severe epidemic, I hope the public will accept that we have to go back to the most stringent level of restrictions. Bloomberg's Mike McKee joins us now for more. Mike McKee, that is quite a contrast.
It is quite a contrast. Changes in latitudes, changes in attitudes. It's all about the virus and where it is hitting. And for us here at Bloomberg, it is about the economic impacts and, to a lesser extent, the political impacts of all of this. I want to start north of the border with Canada. Oh, Canada. That bridge that's been blocked by truckers between Detroit and Windsor, Ontario, carries 25% of the U.S. and Canadian land trade traffic, and it is a major impediment to trade in the U.S. and Canada. Truckers still disrupting life in the Canadian capital, Ottawa. PM Justin Trudeau today accusing the truckers of trying to blockade our economy, our democracy, and our fellow citizens' daily lives, which is interesting because this comes just as U.S. states are starting to loosen up. As the pandemic fades, we're seeing Connecticut, New Jersey, and Delaware announcing they are going to start phasing out mask mandates for school children. And then you go across the pond, and Italy ending its outdoor mask mandate. Austria, Sweden, the Czech Republic going to let most of their mandates lapse. Even the Germans are talking about it. In Australia, border controls being eased. That's not enough for protesters who blocked roads in the capital of Canberra there. Protests also in Wellington, New Zealand. Most of the easing, as I mentioned, comes as COVID cases are falling rapidly around the world. But Greg Valle, who's the political analyst at AGF Investments, wonders today if the protesters are going to take credit for this, leading to even more protests, not just about COVID, but about other social issues. No protests in Hong Kong, though. As you mentioned, leaders there increasingly adopting the mainland policy of no COVID, zero COVID, limits on gatherings imposed today. Residents also dealing with some food shortages because truckers can't make it across the bridges to Hong Kong.
Mike McKee, two different worlds. Thank you, sir, on the latest of these restrictions. A number of years ago, when Chinese state funds started to go into the equity market, it was quickly called the Plunge Protection Team. Do you remember that? We used to have that name for what happened in markets here in the United States a while ago, too. Overnight, apparently that's what we saw. Equities bouncing off the lows, reportedly because state-backed funds came into the market to buy Chinese shares. We get to Damien Sassow for more on that. Hey, Damien.
Hey, how are you, Jonathan? So, yeah, that's exactly right. The market was down 2.4% overnight, and then the Plunge protection team came right in and got the market back up to where it needed to be, I guess. Look, China's equity market is in a bear market. I mean, it's down 20% off of last February's high. The reality is this. What is driving the weakness? It is weak consumer spending. It is weak tourism. I mean, tourism receipts are down 70% year over year in China, at 70% since pre-pandemic levels, sorry. And movie box office receipts down 20%. All this data is coming in. We knew it was going to be a weak Lunar New Year holiday, Jonathan, but not this week. And so on top of that, you see BABA listing shares here in the U.S., which means SoftBank selling. You see 33 new entities added to, a U.S. kind of banned list. So, yeah, you had quite a bit to drive the market lower. And of course, here comes state-backed funds in China riding to the rescue once again.
Unreal, Damien. They're going in one direction. We're going in another. Globally, we have to sort out the supply chain situation as well, Damien, and I just wonder how we do that. Dr. Amish Adauja of Johns Hopkins was on with us earlier this morning on Bloomberg Surveillance, and he said the Chinese, China, Hong Kong, they're going to find it very difficult to open up.
Yeah, no, impossible. I mean, zero COVID just can't work. I mean, look, we all know this. It's a matter of whether or not they relent. I mean, look, if you believe that China's going to stick with it, they're going to have to cut rates. They're going to have to front load all of their total social financing inflows in the first half of this year. And what's that going to do? It's going to drive rates that much lower. I mean, 3-year China-U.S. yield spread is now 70 basis points. 70 basis points. It was 300 in November, Jonathan. 300. The 3-year spread between China and U.S. yields is at 70 basis points. That means the yuan has got to depreciate from here.
Damien, people can criticize the Plunge protection team and laugh about it, but do you take some real signal from that?
Absolutely.
Isn't that important that there is a real shift taking place?
Well, what they're buying, right? I mean, what were they buying overnight, right? They were buying utilities, energy, and financials, and not just any financial. They weren't buying property developers. They were buying brokers. They were buying banks. So it just goes to show that's where China's head is at. And, you don't really want to fight the PBOC and you don't want to fight Beijing.
You've got to listen. You've got to pay attention. As always, Damien, thank you, sir. Damien Sassow of Bloomberg Intelligence. Let's get you some sector price action this morning. As always, we can do that with Kriti Gupta. Hey, Kriti.
Well, good morning, John. Well, it's pretty clear what the story is in the stock market. It all really comes down to the cue that the bond market is leaving. Your leaders this morning are going to be financials, utilities, and materials. Financials, of course, following the lead of that 10-year yield, which is nearing 2%. With it, you also see some other yielding sectors in the green. Utilities, consumer staples as well, nudging higher, but your laggards are once again going to be big tech and energy, which is actually taking a breather. Pretty normal, just given the run up that sector has had. One of the biggest weights on an individual level is going to be Nvidia, though. And this, of course, comes off the ARM deal that now actually really fell through. SoftBank saying instead they're going to pitch it as an IPO. So, of course, weighing on Nvidia, not just for the S&P 500, but for the SOX index broadly. But today, on an intraday basis, the SOX index actually in the green. You'll remember, John, it wasn't too long ago where chip makers and EVs were actually booming. This idea that this was going to be the next big thing. In this year, however, in 2022, that is not the case.
I used to interview the CEO of ARM when it was listed in London, and now we're talking about relisting it after buying it. And Kriti Gupta, thank you very much. I think Anna Edwards earlier this morning said it was back to the future for the likes of ARM and maybe others too. Equities this morning down about 0.1%. Coming up, the market moving events you need to be watching. That'll be next in our trading diary. From New York, this is Bloomberg. 25 minutes into the session this morning. Good morning to you. We're down just a little bit on the S&P by a little more than 1/10%. Banks lead here. Bottom of the pile. The Nasdaq down about 0.2%. Let's get you a read on the why. It's in the bond market. We can talk about twos and we can talk about tens. Twos right now at 133. Tens at 197. Almost the highest since the summer of 2019. A 40 basis point plus move year to date so far. As the price action, let's get you the trading diary. The US auctioning $50 billion of 3-year notes at 1 p.m. 10s and 30s later in the week. President Biden delivering remarks at 1:45 Eastern Time. Wholesale inventories coming up on Wednesday. Plus, we'll hear from some Fed speakers too. Then a little bit later in the week, another read on inflation on Thursday. CPI, the big one, and initial jobless claims coming as well. We round out the week on Friday with the University of Michigan Consumer Sentiment Survey from New York City. This was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.